Welcome to the Business Outlook Survey press conference call. My name is Catherine Dibling, Public Affairs Specialist at the Federal Reserve Bank of Philadelphia, and with me is Mike Trebbing, Senior Economic Analyst also with the bank. Today we will talk about what our manufacturers had to say about activity in their plants this month. But first, Mike will give a brief summary of the report. Mike?
Thanks, Kathy. The indicators from our December manufacturing survey suggest that activity rebounded this month from lower levels of activity reported last month following the aftermath of Hurricane Sandy. In particular, the diffusion indicators for change in general activity, new orders, shipments, and employment, which were all negative last month, turned positive this month, suggesting positive growth. Our price indicators suggest that cost pressures were little changed from last month, but slightly more firms reported increases for their own manufactured goods this month. The future indicators reflecting the firm's outlook over the next 6 months paralleled the improvement in the current indicators. Nearly half of the firms expect activity to increase over the first half of the year, and about a quarter of the firms expect to increase employment. And in our special questions this month, we ask, as we have in previous years, about firms' expectations for various categories of expense next year. And as in the past, as in past years, health benefit cost increases exceeded the cost increases, other cost increases by a significant amount. For example, while wages are expected to increase about 2% next year, health benefit costs are expected to rise about 7% among the reporting firms.
Thank you, Mike. Question, Stephen Joyce, BNA.
I want to give you a chance, Mike, to refute my earlier comments on some of your more negative reports. Sort of across the board, it looks very good. What is driving sort of a uniform improvement, do you think?
Well, I think, as I mentioned in the summary, some of this recovery was probably a rebound from the negative effects in November of the hurricane. You know, from special questions last time, the last 2 months of October and the duration of some of the closings and slowdowns in November were evident in those numbers. So along with comments this month, we know that there's been some recovery. In fact, some business pickup as firms are supplying materials and machinery parts and cement and those kind of things to the recovery process. A lot of it's evident in a couple of the numbers. For example, shipments increased by about a quarter of the firms,
right,
showing increases in November up to over 40% of the firms. So that rebound in shipments is most evident. The other indicators, the improvement really came from fewer firms reporting declines rather than increases. So we're trying to level off the impact from the storm from underlying growth. But the activity index at least is positive again, and it's just slightly ahead of where it was in October.
So if I'm understanding you correctly, you're saying the more positive diffusion is not necessarily because of an increase, it's because the decreased numbers are going down. Is that correct?
Partially, yeah. But on the other hand, we saw an improvement in the 6-month forecast too, which kind of goes past just the backward-looking change from November. So that all those signs are, I think, encouraging.
Okay, and Kathy, if I could, one more, and that is on the point that Mr. Trebbing just brought up. The increase in the 6-month forecast is 46.6. The labor indicators also are positive. When I speak to businesses, particularly in the financial services industry, the uncertainty over the fiscal cliff and other items that are leading to uncertainty, tax changes perhaps, are depressing outlooks, and yet your outlook looks quite good. Can you comment on the fiscal cliff impact on this month's survey and why why the more rosy than other indicators when it comes to 6 months ahead?
The only comments I can give with regard to why they answered the questions this way is the comments that we did receive, and I must admit that the uncertainty about fiscal and macroeconomic events going forward are still present in the comments. But they are at least, and those 6-month indicators have bounced around a lot the last few months, but at least they're ending the year on a positive note.
Thank you.
Okay, questions. Mike Armstrong, Philadelphia Inquirer.
I guess, Mike, on your last point there on the 6-month indicators bouncing around, I mean, it seems like it bounces around all the time as people keep looking out ahead. I mean, what should we take from it? I mean, do you look at that as just something over time? How should we, as reporters, interpret a 6-month ahead look?
Well, I think most of the emphasis is on the current numbers, because it's a fairly decent read on what's happening, in the same month that we release these numbers. As mentioned before, the impact of the storm, is had some effect on these 2 months worth of numbers at least. But I think, to use the 6-month indicators along with the current numbers are sometimes revealing, and we do have over close to the half of the firms are expecting improvement in activity over the next 6 months, and a little bit of improvement on the new orders side as well. So keep in mind that the indicators are just direction of change. They're not telling us as much about the pace of growth. And sometimes when the comparison is against levels that are currently fairly low or tepid growth, the 6-month indicator's probably going to mean a little bit less.
Okay, questions. Kathleen Madigan, Dow Jones.
I noticed the prices received really bumped up, and it was a combination of a few more people increasing their prices and a lot fewer decreasing. Could that reflect something, just a year-end pattern that isn't seasonally adjusted, or is there another explanation for that?
No, on the paid side, the numbers are very close to last month, and as you indicated, a slight increase in the share of firms reporting higher prices received, from about 16% to 20%, and a decline in the share reporting price decreases from 12 to 5%. So diffusion index really measures the balance of those two categories. We did see a couple of comments about price increases expected over the very beginning of the year, and some of these may be pass-through costs for energy or whatever, but the comments didn't really reveal very much about the bump up in the prices received number.
All right, thanks.
Mm-hmm.
Questions. Ellen Froelich, Reuters.
Hi, no questions, thank you.
Okay, follow-up questions. Stephen Joyce, BNA.
None. Thanks.
Mike Armstrong.
None, thanks a lot.
And Kathleen Madigan, Dow Jones.
None for me, thanks.
Okay,
Kathy, this is Katie Etter at NJBiz. Sorry, I'm on the line too.
That's okay. Hi, Katie.
Hi, I just had one question. For Mike, are the firms kind of reporting that they're back to where they were before Sandy? I know the index was kind of flat back then, or are they better than flat in this report?
Since we don't ask them questions about levels of activity, but just change from the previous month, there's really no way of knowing that. We occasionally will ask them about growth rates over a quarter or levels of activity, but in this case, really the measures are intended to measure change more than levels.
Okay, thank you.
Yep.
Okay, thank you. You've just been watching December's Business Outlook Survey press conference call and commentary with Mike Trebbing, a senior economic analyst here at the Philadelphia Federal Reserve, and me, Catherine Dibbling, senior media representative, also with the bank. Just to note, the survey's annual historical revisions, which incorporate new seasonal adjustment factors, will be released on Thursday, January 10th, 2013 at 10 a.m. Next month's survey will be released at 10 a.m. on January 17th, 2013. Happy holidays to all.